Hi guys, so in the last video we put together our shortlist of stocks, and now that we know what we want to trade, we need to consider how we're actually going to go about trading. And it's here that I want to introduce you to a concept which is spread trading. So you need to consider the risk exposure you've got when taking a position in any stock, okay? And to give you an example of that, when you take a long position in a stock, you are exposed to the risk of that particular company. So for example, if the company lost a major contract, that would be stock specific risk. And you need to look at the both industry and sector risk as well of that stock. So industry and sector have a huge weighing on stock price movements. Let's say, for example, if we look at oil, it's a prime example, we've seen a huge pullback in the price of oil, which impacted that entire sector, the entire energy sector, and specifically the oil and gas industry. And we've seen stocks across the board negatively impacted with the huge pullback in oil prices. So that's a very good example of looking at sector and industry risk exposure. And then lastly, you've got market exposure, okay? So if you look at the flash crash we've seen a few years ago in Asia, that's something that you wouldn't have been able to call. And what we need to do is we need to think of a way to, or we need to have a process that allows us to reduce our risk exposure. Now, spread trading allows us to achieve that. So when I say spread trading, what I'm talking about is going long one stock while simultaneously going short another stock. And to give you an example, what we can do is, if we take our example of the oil and gas sector again, in order to reduce our market risk and our sector or industry specific risk, we could take a long position in Exxon and a short position in Chevron, because these two stocks are within the same industry, same sector. And what you've done is you've effectively just exposed yourself to stock risk. Okay, so should oil prices crash again, or should we see a flash crash in the market for any unanticipatable reason, then both stocks will fall, okay? But what you've got your long position which will lose money, but you've got your short position which will actually make money on the market pullback. And spread trading, I mean, that's something that hedge funds do, okay? I mean, hence the name, hedging your bets. Spread trading is an excellent way for you to achieve the same thing and really reduce your risk exposure. So what we'll do in a moment is jump onto the computer and I'll show you how to put together a spread trade with your ideas, okay? What I want to touch on as well is there's two ways you can spread trade, really. You can do cash for cash, okay? You could buy 1,000 shares in Exxon and short 1,000 shares in Chevron. But what we want to be doing is actually looking at taking a more professional approach and considering the beta of a stock. So if you're not familiar with that, read into it. But a beta of a stock is essentially the volatility of price relative to the volatility in price of the market as a whole. So if we've got a beta above 1, what that means is that for every 1% move we see in the stock market, so if we're looking at the US, if we've seen a 1% move in the S&P 500, if a stock's got a beta of 1.5, say, that's reflected in a 1.5% increase in price in that specific stock. And the reverse is true. So anything less than 1 just means that a stock is less volatile to volatility relative to the market. So if you had a beta of 0.5, then for every 1% pullback in the market you've seen, you'd only see a 0.5% pullback in your specific stock. And there's a lot of different ways to measure beta. I mean, I'll trade over a 1 to 3 month time horizon. So specifically, I'll look at a 90-day beta of stocks. And then when I'm taking a long position and a short position, I will use beta to calculate the relative position size rather than doing cash for cash, because stock betas vary depending on what industries you're looking at and obviously what stocks you're looking at. And you want to make sure that you're hedged as best as you can be, okay? Because not all prices fluctuate the same. So that's what we need to look at. Now, let's jump into the computer and I will show you how to structure your spread trades as well as calculate your position sizes. Hey guys, so first thing I want to do is jump into Excel just to help you visualize what I was discussing earlier about risk exposure, if we look at the example of Exxon and Chevron, that was an intrasector spread trade, okay? So what I mean by intrasector spread trade is that we were simply long and short stocks within the same sector, and by doing that what we've done is we've reduced our market risk exposure as well as sector risk, and we're very much just exposed to the performance of both these companies, alright? If you want to look at a cross-sector constituent spread trade, this is simply buying stock within one sector and shorting a stock within a completely different sector. So an example of that would be going long a stock within consumer discretionary while simultaneously going short a stock within the utility sector. So when you're structuring your spread trades, you need to take a look at the historical relationship between these two companies, and to be able to do that we need to chart it, okay? So first things first, we need to obtain the historical data for both Exxon and Chevron, and in order to do that what we'll have to do is jump onto Yahoo Finance. You can find that data by finding the stock that you're after. You've then got this historical data section, and what you need to do is simply look at the daily pricing and obtain as much data as you possibly can by choosing max. Hit done, apply, and then what you'll be able to do is download the closing price as well as the date, okay, for each of these stocks. Now once you've consolidated this data, it's simply a case of taking your long position, which in this case is Exxon, and dividing by Chevron, okay? So this has been done here, and what we'll then do is create a chart. So all I've done to create this chart is simply selected the spread, okay? So I suppose that's a result of the equation of Exxon divided by Chevron, and map that to the date. And what that does is that paints a picture of this historical relationship, and looking at these charts you very much want to treat them like you would a stock specific chart, because you want to be looking for areas of support and resistance, look at the general trend, and just generally monitoring price momentum and ensuring that it's moving in the right direction for you. When it comes to calculating your position size, we talked about going cash for cash or beta hedging. So let's take the scenario of putting 2,000 towards this trade idea. If we want to do cash for cash, it is quite simply a case of putting 1,000 towards Exxon and 1,000 towards Chevron. However, if we're wanting to beta hedge, okay, so beta being a measure of stock volatility relative to its market volatility, what we need to do first of all is just get the beta figures. So back onto Yahoo Finance, just under the statistics section, you can see at the top here we've got beta, okay, so 0.64, I've already fetched that to try and save a little time, and I've done the same for Chevron. Once you've got beta, we can calculate beta weight, okay? To calculate the beta weight, what we're simply doing is summing the betas for both stocks, okay? And then for Exxon, we're taking its beta and dividing it by the sum of the two betas, so that's how we get to the end beta weight. That's all this formula is doing in both cells. If that's a little bit unclear, I will make this worksheet available on the website. I'll put it just under the video, so you'll find that on the how to buy shares section of the site. Once you have that beta weight, you can then calculate your beta position size, okay? Now, what we're doing here is taking the balance of 2,000 and we are multiplying it by the beta weight of the other stock, alright? So if we're looking at Exxon, we're taking this 2,000 and we're multiplying that by 65%, and then we're dividing it by the current price of Exxon, as you can see here, and we're doing the same for Chevron. So Chevron, it would be the 2,000 multiplied by Exxon's beta weight of just 34%, and then dividing it by Chevron's share price, okay? And that's how we calculate how many shares we want to put towards each stock. Now, the reason for this is because if you look at the beta of Exxon relative to Chevron, you'll see that Chevron is not far off twice as volatile as Exxon, okay? So there's more volatility in Chevron's share price relative to Exxon, and to balance out this beta, okay, so that should we see a big pullback in the sector, we want both share prices or the net amount we've got invested in each of these stocks to fall at the same rate. What we're doing here is we're putting more in the less volatile stock, so that's Exxon. Okay, you can see here there's twice as many shares purchased in Exxon as there is in Chevron, with Chevron being twice as volatile. Now, obviously, share price does have an own influence there, but that is the reason we cross-multiply the beta weights. Alright, if that was a little bit confusing, again, I will leave this worksheet available on the website for you to take a look at the formulas. Once we've got the position sizes calculated, we can then place a trade. So that covers the topic of spread trading, and we've covered a lot in this 4-part video series that gives you a complete overview of the strategy, tells you how to generate your worldview, as well as picking the best sectors that we believe will outperform the market, and then drilling down into the stock selection process, and finally structuring our spread trades, okay? Now, there's a lot to this. I've given you a lot of information to digest, okay? So go through the video series again. I'd encourage you at this stage to jump onto the Trading FM website, okay? Leave your comments in the Trading FM forum, so any questions you've got about this strategy, just let me know, okay, and I will respond. And there you have it. That's it. That is how to spread trade and calculate position size.